On this segment of Strategic Wealth University, we're going to be talking about bull markets and bear markets, the difference between the two, how to spot them, and how a portfolio can be positioned during these different economic climates. So first off, what's a bull market? So a bull market is where a market is rising or is expected to rise. This in turn creates and promotes consumer buying, which continues to rise the price or the overall market index. Now, if we flip that on the other side, what's a bear market? So a bear market is where a market is falling or it's also expected to fall. Now, this in turn creates and promotes consumer selling, which continues to lower the price or the overall market index. Now, let's take a look at some past scenarios where bull markets have occurred. If we look back at 2000, we have the dot-com bubble. So after this followed a bear market. If we look back at 2007, 2008, we have the real estate bubble, and following we have a bear market. So if we look at 2014, 2015 area, we have a bull market caused by a variety of factors. Now, looking at the market climates, we can start to see a pattern emerge. We see a period of a bull market followed by a bear market. And what happens is yet to be determined for our current economic cycle. But if we look at past historical data, it's safe to say that another bear market is soon to follow. So something that we talk about is the likelihood of a market correction happening. Now, a correction on average happens every 7 to 8 years. In the 7th year, there's about an 80% chance that the market's going to go through a correction. And in the 8th year, that number jumps up to 90%. So we only have a 10% chance of generating a positive return in the 8th year. I don't know about you, but there seems to be so much more risk than there is really reward. Now, something that's very interesting is how these cycles, or bull and bear markets, travel, meaning how they move up or down. Now, a major misconception, especially for a bear market, is that it moves only down, meaning that the only direction over the term of the bear market is that only moves down. Now, what we see from past historical corrections or past bear markets is that there are and have always been wild upswings too. There could be a 15% downside correction followed by a 5% upside correction, followed again by a 10% downswing. Now, the most important thing to take away from this is that the 5% gain doesn't always indicate that the correction is over, and it is extremely difficult to time these brief or minor upswings. A lot of investors make the mistake of buying back into the market towards the peak of these minor upswings, and then as soon as the buyback or as soon as they buy back in, the price level or the investment continues to fall. In this instance, it is really important not to try and catch a falling knife. If you see that something's falling or it's probably heading that direction, it's best not to guess its floor or predict its bottom, because more times than not, based on statistics, we are not going to be able to consistently and accurately determine the floor of an investment. Now, bull markets are a bit more predictable, and while there are seemingly continuous upswings, there are some downticks as well. But the key thing to take away from bull markets and bear markets is the trend. I know we're about to have some graphics come up, so let me go ahead and explain these. In this first one, this is an upward moving bull market trend. Now, what do we see? We see an upswing, a small downswing, but the bottom point or the change of direction is never lower than the last uptick, meaning that each time there is an upward cycle, we're still higher than we were before. Now, let's go ahead and flip the graph. I want to take a look at a bear market. So we can see from this that there are continuous down and upswings. But what we can take away is that each time we have a brief upswing, it is never higher than the previous downward point. Now, investors will often see this trend and think the bear market's over. Then the behavior kicks in where they don't want to miss out on the gains, and then they buy back in right before things to head back down again. So again, if we look at some numbers, we can see that the average investor cannot effectively time the market. The best thing to do when we're riding the roller coaster, so to speak, is to first and foremost consider getting off the roller coaster to avoid further drops. And also, one thing we really need to try to do is to maintain patience. Now, what comes to mind? You think, all right, I have this information, but how do I position myself for a bull or a bear market? How can I achieve safety but at the same time see a reasonable rate of return. Now in bull markets, equities or stocks typically will have reasonable returns. During a bull market, to fully capitalize on the upswings, a portfolio will help maximize itself by having stocks or equities. Now on the flip side, what do we do when we have a bear market? First and foremost, we have to have a properly allocated portfolio, meaning that we need to have a large portion of our portfolio in investments where we never have to worry about losing anything. Something like this could be a CD. For something with some more potential upside growth, an annuity could also be an option. Now the portion of the portfolio that we have more upside potential for, that we've decided that this is the portion where we can have some risk or take some risk. We can have stop losses on those positions. Now this enables us to sell out of the portfolio or each holding at a certain predetermined price that we determine. So really understanding past historical bull and bear markets is vital for determining when to invest and really when to get out of the market. If you would like more information about how Strategic Wealth invests in and during these economic climates, please give our office a call or feel free to check us out on the web.